My name is James Seyffart. I work in Bloomberg Intelligence. I write research about the asset management industry, ETFs, and I do a lot with crypto and the overlap between TradFi and DeFi, if you will. So we're going to get in and we're going to talk a lot about tokenization and those overlaps. But before we do that, I'm going to let everyone just give a little bit of a rundown about who they are and why the heck they know anything about tokenization to begin with. So let's start with Manish.
Hi everyone, Manish Dutta. I'm the co-founder CEO of Alpha Ledger. Started in 2019 after being at PIMCO for 20 years. The one thing that was clear to me while leaving PIMCO was everything that can be tokenized will get tokenized. And we started in 2019 during Gensler era. That was sort of interesting period. We have tokenized well over 800 million in municipal debt. We recently launched a private alternative income fund with Simplify Asset Management. And happy to be here.
All right, thank you. Nick, why don't you give us a little background on why you know anything about this space?
Sure. Thank you so much for having me. Hi, everybody. My name is Nick Ducoff. I'm head of institutional growth at the Solana Foundation. Solana, if you're not aware of it, is the most used blockchain in the world. And Solana was the fastest venture capital-backed company to achieve a $100 billion market cap in 5 years. Faster than any other Magnificent Seven or FANG stock. And I lead institutional growth at the foundation, so I work closely with asset managers, banks, issuers, financial institutions all over the world to tokenize everything and in a single liquidity venue, and that's what I'm here to talk about with you all today. Thank you.
And unfortunately, Robert isn't here with us, so we got to upgrade here. So Mike Green is stepping in, and he can pretty much talk about anything. So I don't know if he really needs a full introduction, but...
Mike Green, Chief Strategist to Simplify. I'm just here to complain about Bitcoin.
All right, something you said, Manish, really makes me think about what's going on in tokenization. You as well, Nick. I have a feeling maybe I'll be pushing back on some of your guys' views of where things are going to go. But the way I see it is there's two worlds, right? Either you're in TradFi and you don't understand the space at all, and you look at it and it's nothing but scams and fraud, money laundering, a joke, if you will. Or it's more along the lines of what you were saying, where you're in this space, you religiously believe in the asset class, the technology. You're it's a matter of time before these systems take over and everything is tokenized. And I kind of sit more in the middle. There's some regulatory issues and things along those lines, and maybe we could get to that future, but I think it's a long way out. I guess can you just talk about what it is on those rails that you think is why everything, all assets are going to be eventually tokenized? Yeah. And what is tokenization, I guess, really, from your point of view?
Sure, yeah. I think it's important to talk about tokenization away from blockchain first, right? So tokenization as a concept is a computer science concept that has existed since the 60s, used for parsing text. And then it was used by credit card companies to sort of ensure that there is safeguarding of the data transfer, right? So if you go from tokenization as a concept to tokenization being used for encryption, to now tokenization, which really represents an asset on blockchain. What we're really talking about is programmable securities. And I believe that's the next fundamental change coming to the market, because what we have seen over the last 20 years really is we've gone from paper tickets to Bloomberg terminals to STP. But what that really means is when Mike Green or anybody else is doing a big trade, he's letting the middle office know. Middle office talks to the back office talks to the executing broker, then they talk to DTCC, then they talk to your custody banks. All those things are step functions that take place today when you do a trade. When you get into tokenization, it really becomes a programmable asset, which means faster settlement, atomic settlement. It means the ability to sort of create composability. So I think with the growth of technology and the growth of blockchain as a technology, really, it becomes a fundamental step to bring the traditional assets on chain for atomic settlement, for ownership, and then really composability of the asset.
So let's stick on this. When you say composability of the asset or programmatic assets, can you give us examples of what you're talking about in those pros and cons, I guess, theoretically?
Yeah, sure. So the minute you make an asset programmable, that means an asset manager cannot trade without it following the rules. So it must trade on a Thursday when it's raining outside at 75 degrees. Today, there's a compliance person that's sitting behind the computer making sure that the rules are being followed. When you program an asset, it must meet those conditions. So whether it's tied to the the weather channel, whether that's tied to the concentration limits, all those things come into play programmatically, which would then either allow Mike to trade or not trade. It would allow Nick to own the asset or not own the asset. It would allow your investors to be notified real time that the actual trade did take place. So I think that's where really tokenization comes into play. As it relates to composability, when you buy an asset, it sits in your brokerage account. Unless you're super wealthy, you're not doing sec lending. And if you really want to do it, you got to fill out tons of forms. So when you make an asset tokenized, it becomes composable. That means you can leverage, you can borrow, you can lend against it. And that's really the fun of being on a public blockchain, which actually opens the doors for millions of people, the new sets of investors that are already on here, and why tokenization really matters.
All right, let's move to you, Nick. Like, anything he said there you disagree with or you want to build upon? Like, what do you guys at Solana Foundation define tokenization as?
Yeah, I mean, I think I would focus on a few of the things Manish said and re-emphasize them. I think it's about access. I think it's about speed. I think it's about cost. And those three things are massive upgrades to the current system. So in terms of access, today on the blockchain, anybody can buy any asset subject to the conditions that that asset may have anywhere in the world 24/7. On the other side of the equation, business owners and asset owners can sell that asset or shares in their, or tokens in their business to anyone, anywhere in the world at any time. So it radically democratizes not only access to assets, but for asset owners, access to capital. So access is one. Speed is the second. So on Solana, finality is about 400 milliseconds longer than it took for me to say that. We're working on a new technology upgrade that will reduce that to about 150 milliseconds, so virtually instantaneous. And I think the speed of everything is faster. Raise your hand if your computer or your cell phone lags even for 1 second. Don't you want to throw it out the frickin' window? Right? So everything's going faster, and Solana is the fastest blockchain in the world, and blockchains are just faster than current systems. So that's the second. And then the last is cost. And this one is a bit trickier because we all fight like hell to capture profit, right? Like that's macroeconomics 101. However, competition ultimately will continue until profitability is driven to zero. That's macroeconomics 102. And there's a lot of intermediaries that take a lot of cost, across many systems, in the banking system, in the asset management system, in virtually every system. On the blockchain, everything is peer-to-peer, and there's virtually no fees. And that's radical, and there's a lot of entrenched interests that are going to fight against that. Citadel, for example, recently went to the SEC to dispute kind of tokenized equities trading, or at least have a seat at the table. Why? Because they're losing fees to tokenized equities that are trading on the blockchain. I anticipate they'll find a way to participate because they're very smart, but I think this is the type of competition that ultimately will drive better outcomes for all market participants over time. So those are the three. Yeah,
so I mean, I have no pushback on the speed thing. I do have questions about access because if you're like, there's regulations, there's reasons that like people around the world can't get access to Apple stock. There's specific reasons like that. So I think there's a lot of regulatory concerns and questions around that. I don't know if you have any thoughts there around like how you prevent, like you have these open, decentralized, open source protocols, but there's still laws in the real world that prevent some of this from happening, theoretically.
Sure, so I am a securities lawyer, but for the purposes of this panel, I'm not. But I think we have a very patriarchal system. And so when you say there are people that aren't supposed to buy Apple stock, I think there's many more good people in the world that can't buy Apple stock than there are bad people in the world that are trying to buy Apple stock. And I'd argue that if a bad person, meaning they're on some kind of sanction list, wants to buy Apple stock, they will figure out a way to do so. What we're trying to solve for is the billions of good people in the world who want access to things like Apple stock, which, by the way, you can buy on Solana today, that can't, or it would be prohibitively expensive, even if they could, via ADRs in their local stock market. And so I think that this is one of those things where the good outweighs the bad, and have we solved it perfectly yet? Maybe not, but I think that's the direction we should be headed in.
Yeah. Okay. The other thing I would ask is like the speed, the atomic settlement. Like there is some benefit to the netting that happens at the DTCC and things like that with fraud prevention. Stuff that takes a day, it can get caught. But I guess that you would just probably argue there's pros and cons to that, and the benefits outweigh the negatives.
Well, I mean, so not everything on chain is a bearer asset. So one of the kind of weird things about the blockchain is that is the predominance of bearer assets. So who here has heard of stable coins? I don't want to be presumptive. Okay, only a handful. So there was a bill recently passed in Congress called the Genius Act, which basically set rules but made it okay for folks to use stable coins in the US and those folks including financial institutions. Won't get into the details of that. Stable coins are essentially on-chain representations of the US dollar. Okay. The thing that is unique about stable coins is they're bearer assets. I don't know about you all, but I don't have like a ton of cash like stashed under my mattress, right? Like if my house burns down, that cash is gone, right? Similarly, if you're holding stable coins in a wallet and you lose access to that wallet, you're toast. That's it. You're done. No way to get those stable coins back. They're bearer assets, like the old bonds that you might have held as bearer assets. However, on-chain equities, as Manish was describing, you can set rules to those tokens. And one of those rules might be revocability, where if it ends up in the hands of someone that it shouldn't, I can pull that token back, right? So you can enforce rules on the blockchains for tokens, especially security tokens and other tokens that should probably have some level of permissioning.
Yeah. Actually, so James, I want to go back to the regulation question. I mean, having built a broker-dealer from ground up and a transfer agent, I can tell you that some of the rules make absolutely no sense, right? So today, accredited investor status is $200,000. So if you make $199,099, you're not an accredited investor. You could be the smartest person in the room, but you're not an AI person. So that rule makes absolutely no sense to me. So I think as we think about regulations, they were built for a paper era. And as we think of regulations now, and the new administration obviously is making a lot of changes, they're making changes faster than we can sort of keep track of. I think that new era is here, which is how do we take this brilliant market that is 50 plus trillion in equities and probably more in fixed income, which is close to 60, 70 trillion dollars. How do we bring them to a public blockchain, which allows for transparency from an asset management standpoint? And more importantly, it really starts to unlock access even for people in this country that don't want to be holding US dollar as a fiat, but perhaps a USDC as a stable coin, which then allows them access to these assets, and they're perfectly qualified to be able to buy these assets.
Yeah, I'm with you 100% on the AI stuff. I think it's been 200,000 for like a few decades too. So
Right.
Technically that number has gone down as inflation adjusted. Let's go to you, Mike. I mean, you're famously relatively anti-Bitcoin, but you're not anti this tokenization or some of this other stuff I've heard you speak about. So what is your view on tokenization and some of the stuff that they just said?
Yeah, no, I think directionally I would completely agree with the points that are being made. Much of the legacy system is built in a way that was designed to effectively accommodate the existing participants. Unfortunately, the Genius Act stablecoin is just another example of that, where very poor choices were made to preserve franchises under lobbying. I think that we're at that point, and this is part of the reason why the panel is titled "The Future Is Now." There's a famous quote, right? The old world is dying, the new world struggles to be born. I very firmly believe that's what we're actually watching. The paper record keeping, the paper and analog era is coming to an end. The importance of having things be digitally native is actually now at a point where the returns associated with it are off the charts, candidly. So I am actually extraordinarily excited by the technological changes and the innovations that are being created. And I think, as you know, I've actually filed a couple of patents at this point trying to tackle components of tokenization that I think are not being properly addressed. That integration of tradfi familiarity with things like financial primitives, with understanding why we do what seems to be logically incoherent in many ways, and how that has to be translated into the digital world is the primary role that I actually see for myself in this stage.
So from my point of view, like I've been hearing about tokenization it's going to take care of things for like 5-6 years. Granted, I was in the weeds a little bit earlier than most, but like, I guess my question is like, what is going to be tokenized? When is it going to happen? The only thing that I found like real product market fit is what we've been talking about, stablecoins. Like there are people that don't care about being on chain as much that are using it in third world countries or countries around the world to get exposure to the US dollar. But for the most part, these money market funds that are on chain, these other things that have been tokenized, these tokenized treasury funds, what I see is like, one, it's relatively small still, but two, the people using it is more people, they're already on chain and they just want access to TradFi. So we're seeing these bridges built, and it's only the stuff that's tokenized is being used by people who are already on chain, not like people going on chain to use it. Yeah. And then I also see, the bridges going the other way with the ETFs, where you have, we're taking these DeFi assets and putting them on TradFi rails and going from there. But like, when is this all going to happen? How is it going to look? Like, what is the timeline here? I keep hearing about it, and really the only thing I see doing well is stablecoins.
Yeah. So look, I left in 2019, a very traditional shop. I can tell you it's taken us 5 years to build a broker-dealer and a transfer agent. For the first 3 of that, we're just simply trying to get the SEC and FINRA to understand that blockchain technology and Bitcoin are fundamentally different things. Bitcoin exists on a blockchain. Blockchain does not exist on a Bitcoin. They just happen to be the network. And same thing with Solana. Solana was not even created in 2019. So I think what you're really seeing is a maturation of technology. That's fundamental, number one. Now you need the buying power that effectively is the use case, which is USDC. Up until this year, we didn't even have a Genius Act. We don't have to like it, but it didn't exist. So everybody ran to Cayman Islands and everybody else and started to create a dollar-denominated currency to buy things with. So we have that now. We now also have private funds. So you talked about the BIDL from BlackRock. There is the Simplify Alpha Ledger Fund, which is a 12% distribution fund. That's on Solana. Surprisingly, we have investors in that fund that are traditional investors looking to move their US dollars onto a public chain. So then when the distributions take place, or if they want to come out of the fund, they have access to crypto rails. So that's starting to take shape. The next step really is the tokenization of ETFs. Because what you're going to really see is the yield hunters, as I call them, are already on chain. They're now looking for stable products. You're starting to see the first wave of that through private funds because the current regulations weren't good enough to create a publicly traded ETF purely to trade on Solana. We happen to be on Solana. But I think that's going to change. I think that the tokenization of an existing ETF is going to come, and you'll start to see a wave of that starts to create a data point for people to come and buy into it.
Okay. So I guess let's go to you, Nick. Does this at all, like the rules that you can make, like when I think of when I think of tokenization and blockchain, and I think of the cypherpunks and like open permissionless networks and all these things, but like everything we're talking about here doesn't really sound like that at all. So like, how do these ideals mesh with like what you guys are doing at Solana Foundation? Because you're talking about revocability of different things, and like, as somebody who like was really bullish on Bitcoin or Ethereum back in the day, like that sounds like like that's not what they wanted to do. So how much of this is just like technology on the back end versus what's actually happening?
All right, let me approach this question in a couple different ways. First, the way that I think about tokenization is as a building block, and I'll give you an example. So we talked about stablecoins. This year on Solana, stablecoin has gone from 5 billion of stablecoins to 13 billion of stablecoins, and it's September. So, almost 2.5 times. The underlying collateral for stablecoins is typically cash, very short-term treasuries, things of this nature. One of the more popular and faster growing RWAs, which stands for real-world assets, is money funds, as you mentioned. And so there's tons of money funds on Solana, from BlackRock, from Wellington, from Franklin Templeton, many others coming. Soon, perhaps from folks on the stage. However, for stablecoin issuers, they still hold most of their underlying collateral in traditional vehicles. So when somebody goes to redeem, that's another word for sell in our world, goes to sell directly back to the issuer to get back into fiat, their stable coin, then that issuer needs to go sell down that amount of the underlying collateral. So they have to go put a sell order in. Well, what happens if that's at 4:01 p.m.? What if it's on a Saturday? If the RWA is on the blockchain, that can happen instantaneously at the same time. And so I suspect, by the way, across the blockchain, there's about 300 some odd billion of stable coins and only about 30 billion of tokenized RWA. So it's about 1 to 10 today. I think it should be 1 to 1 of stable coins, just stable coins. And then I think there's going to be other growth because I think more people around the world are going to want to hold their debt and equities in tokenized form. So I see the near-term TAM, and I mean like in the next 12 months, 300 billion, a 10x increase. And over the next few years, I think it's many-fold. But, you know, stablecoin issuers are coming, and they're not coming from just the likes of folks of Circle, which had an incredible IPO earlier this year, Tether, which is now raising money at what will be the highest private market valuation on the planet, higher than OpenAI, Tether, which only has 100 employees.
Right.
These are incredible businesses that are growing very fast. But also banks. Societe Generale has a stablecoin on Solana. Fiserv recently announced that they're building stablecoin capability on Solana for 3,000 partner banks. Visa, MasterCard, others, Stripe. So I think this is happening. I think it's happening, you know, slow if you've been in the industry for a long time, but fast if you're kind of approaching it from where the capability is today, especially given prior to January 20, you were likely to get a knock on your door from one of the 3-letter agencies if you were doing this.
Yeah, before I go to Mike, I wanted to ask you how much of that like long time frame was the fact that Biden and the Gensler administration were just like not willing to work with you at all, or like was that a big holdup, and is this new administration beneficial, or you kind of just you actually got it through with Biden and Gensler at the helm?
We got it through Biden for fundamentally different reasons, because we went with the notion that we are doing securities business, and you can't tell me that securities can't be on an Excel sheet or on a blockchain technology. Now, we were quite careful as to how we phrased it. We didn't go on Twitter. I mean, up until January of this year, I didn't even have a Twitter account. I mean, even though it says I've been on it since 2009. We certainly went with the approach that we went with a permission blockchain, right? So I think you were working with the SEC and the FINRA and the MSRBs with your hands tied behind your back, just to simply show them how a technology works. And once they got comfortable with that, they still put restrictions. Today, we have gone the opposite direction. So I think that's why you're seeing a slew of activity coming onto public blockchains, because I think that's really where the value of blockchain lies, not in private permission databases that organizations already have. You might as well just trade on CSV files and just run a nightly batch cycle.
Yeah, this reminds me of like the 2017 era where everyone was saying blockchain, not Bitcoin. It's not quite that far, but it's also not fully just Bitcoin. People are actually starting to use this technology. I mean, Mike, what do you see, like, what are the biggest pros that you see from here? You said you have patents in the space, but also like we haven't talked about the negatives. Like what are some negatives? What are some things you're genuinely worried about with building in this space at this point? Or is there any?
Well, I think a couple of them have been introduced just in this conversation, right? I mean, one is this idea that we can decry that tokens are not securities, right? Of course they're securities, and they are absolutely subject to the Howey rule. We should be following that. The industry should have embraced compliance. I agree that the regulatory framework was quite difficult, but candidly, the industry in many ways brought that upon itself, right? We're going to do all sorts of IPO equivalents in 2017 and say we're not doing IPOs and we shouldn't be subject to SEC regulation. It's unsurprising that the SEC reacted to industry participants after that event by saying, yeah, we're not really interested in how you're trying to frame it, right? We are now at a point where all sorts of really interesting stuff is beginning to happen, but there's also some pretty clear evidence marks of things that have happened in the past. You mentioned the Circle IPO, for example. So Circle now has a roughly $35 billion market capitalization. The founder of Circle is Jeremy Allaire. You would expect him to have significant wealth accrue from that. He owns 0.3% of the company. Why? Because stablecoins were such an incredibly bad business in an environment of zero interest rates that he was forced to dilute himself continuously through that process. the fact that the Federal Reserve has hiked interest rates, and now stablecoin issuers on their collateral are earning around 4 to 4.5%, and not sharing any of that with the investors, right? That's a byproduct of the poor design of the Genius Act. It was a way of effectively protecting profits that are now subject entirely to Federal Reserve interest rate policy. These are not real innovations. This is borderline fraud and crime. That can change, right? And it can change, and ultimately I think that the people that are starting to push forward real innovations in the space that have a background in TradFi, that understand components about this, that might have a slightly different motivation set in terms of pushing things out into the public, are emerging. It's not fair for the SEC to say, well, you should sandbox this, you should run it as an experiment, you should allow us to, we're going to allow you to do these things, but you can't participate in a commercial enterprise, because the simple reality is these are costly businesses. This is why Jeremy Allaire gets diluted down to 0.3%. On the flip side of it, I've candidly never expected I'd be on a panel in which Tether was discussed favorably. There is a very clear mantra here, right? There's lots of things that these firms could be doing if they actually wanted to take the wealth that has been gifted to them by the Federal Reserve and be good corporate citizens. Tether could have completed an audit. It's certainly not that they don't have enough funds, right? They have the capacity to do that. They've chosen not to do that, and I'll candidly say that's because grifters are going to continue to grift.
Yeah, I mean, part of this is what you talked about with the Genius Act. Like, they're literally, at this point, not allowed to share
Correct.
their interests. And actually, right now, the bank lobby is supposedly pushing for this market structure bill that's being debated in Congress now to make it even stricter so they can't even share rewards. Like right now, Circle is paying out rewards via Coinbase customers if you hold Circle on their platform. Right. And the banks want to stop that essentially, which is like...
It's not yield if you call them rewards, right?
That's right.
Yeah.
Airline miles. Right.
So I guess that's what you were talking about when you said like when the Genius Act is protecting incumbent industries, right?
Yeah, I mean, this goes down to the components of what I refer to as financial primitives, right? You ultimately need a risk-free asset that you can use to derive an interest rate curve. Almost all derivatives come off of that, right? I actually think Nick spoke far too conservatively when he talked about the ratio of stuff. Because remember, anything that is a derivative of a real-world asset, equities would be an example of that. Well, those can have derivatives on top of them. A call option is simply a derivative on top of an equity. Right? And so you will actually end up, I would argue, having financial assets that have ratios that look very much like the real world today, where it's somewhere in the neighborhood of 100 to 1.
So let's talk about what this future looks like. I hear one of the things that I've been hearing for like, again, a long time is the DeFi mullet, where it looks like TradFi, maybe in the front, like normal what you use as an interface, but in the back end, it's blockchain. Are we going to have purpose-built chains for specific types of assets? Is it going to be general purpose blockchains? Are we going to have layer twos? Like, how do you actually see this playing out with some of these assets? I guess we'll go to you, Nick.
Yeah, I mean, analogies are always hard and imperfect, but you were saying, we've been hearing this for 5 years. If you were early in the internet in 1994. By 1999, you're like, I've been hearing about this damn internet for 5 years. Nothing's going to happen. This internet's a complete dog. And there's like these great segments on like the Today Show. I'm sure you've seen them with like Matt Lauer, where he's like, the internet, what is this thing? It's stupid. Nobody uses it. Are we in 1999? Are we in 2000? I don't think we're in 2001. Are we in 2010? Kind of vis-a-vis the internet. I think we are in like 1999, something like that. And so I think there's just a Cambrian explosion of use cases. Many of which I think we can begin to see if you squint, and I think a lot others that hopefully folks here in this room will create and innovate. If I had the ideas myself, I'd be doing them. That's one of the things that we do at the Solana Foundation. We're a nonprofit that supports the Solana blockchain, and we help to, promote innovative startups, and use cases of the blockchain, like Alpha Ledger that Manish has done. And so, DeFi mullet, how many blockchains? I don't know. In going back to 1999, I don't know about you all. I had like 5 different ISPs. I used CompuServe, I used Prodigy, I used AOL. And by the way, then all of a sudden the Internet Explorers came, Netscape, Yahoo, Google. And the ISPs ultimately went away. Like AOL was the last man standing for a while, but then as soon as you could directly access the internet via browsers, that's what you did. And so where are we? It's so hard to know, but I would say we're extraordinarily early. The fact that you're even in this room hearing about it means you're early. And it's just tremendously exciting. Obviously, I'm a perma-bull for the blockchain, but there's so much exciting things to come.
Yeah, I think there's a lot of things that have been tried to be built, but the technology just wasn't there. And I think like 5 or 6 years from now, it's going to be similar to like how some of those websites that went belly up and are now multi-billion-dollar companies. I think there's going to be stuff on blockchains that people tried to build in the last few years, gaming and things like that, that as we get more performant, we'll see that go there.
Pokemon, by the way, is like absolutely going gangbusters on the blockchain right now. You know, graded. I don't know if who here like either likes Pokemon or has kids that like Pokemon. Like not many. Okay, maybe we'll skip that then.
It's clogging up.
It's called Labubu now, Nick. It's not Pokemon.
Verifiable collectibles on the blockchain is actually like quite a good use case. Turns out, like there's like hundreds of millions of traded a day now of Pokemon collectibles on the blockchain.
Manish, let's talk a little bit about like how you choose what chains to be on and what platforms. Like, what things are you looking at? You've done obviously a lot, mostly on Solana, from what I understand. But like, how did you decide to do that rather than Ethereum, a layer 2, or some other more purpose-built blockchain? Like, what was your decision?
So I think let's take a step back. I think blockchains are purpose-built for execution and settlement. Right?
Okay.
That's the starting point. We were on Hyperledger Fabric as the first chain. I am not a fan of L2s. I think L2s introduce more risks than they really need to, and I think they were built in order to accommodate the sloppiness of EVMs. So I will say that. We picked Solana for it wasn't a binary choice for us, right? I mean, so we looked at a lot of different chains. We picked Solana for a couple of fundamental reasons. One, it was a concept baked in engineering. How fast can we make the token, the settlement, the execution layer move end to end? Right? That was a starting point for the founders for Solana. So to me, that was fundamentally important because I think we hear from a lot of the folks in traditional market talking about 20 millisecond execution, but that's the most expensive trade you would do because your servers are sitting right here. Okay. Then the question really became was, in order to introduce traditional assets on public blockchain, you needed human support. So Solana is a foundation, and not just the foundation that Nick belongs to, but generally there's a human element to this organization, which is a decentralized organization that is willing to sort of solve critical problems, which is, you want token extensions? Do you want to be able to ensure that the amount that's traveling on Solana is not shown to the public? Those works are taking place, and that's what really led us to Solana than any other chain. And I don't think, and I would even go as far as saying that at the end of the day, call it in 5 years, you'll probably have a few chains, right? Bitcoin will remain Bitcoin as an asset class in itself. We don't have to agree as to how it gets valued, but that technology is there. And then you will have Solana and perhaps 1 or 2 more folks, but that's about it. I think all the experiments will sort of die because today there's a lot of grift on blockchain because everybody's trying to build a stable coin, and if they are successful in doing that, then they have to figure out how to build an L1 because that allows them to capture more value. It's effectively going back to PayPal days or Stripe for swiping your credit cards.
Yeah, I mean, Stripe is building a purpose-built layer 1, theoretically. There's a Circle that's trying to build a layer 1.
Yeah, it's more centralized than decentralized. I mean, it defeats the purpose of having an L1 if you're building it just for that one specific purpose. You already have databases that do that.
Yeah, I often hear people saying if you want to just do this, like a blockchain is an inefficient database if it's not decentralized. So maybe let's talk about the decentralization nature, the benefits of that, Nick. I mean, if you think about, like, I think the big 3 right now of Bitcoin, Ethereum, Solana, like you could probably run a node helps decentralization for Bitcoin for a couple $100 if you have the ability. Ethereum, maybe 1,000, a couple thousand. Solana, you probably need like a server, like tens of thousands of dollars. Like, how do you guys think about when you talk to people who are like Seyffart and all about that decentralization? It's particularly when we start talking about these real world assets and tokenizations. It is slightly more centralized. I think of it as a spectrum. A lot of people like to, particularly Bitcoiners, are like, you're either decentralized or you're not, and I definitely don't think that. I think about it the same way as active passive, which me and Mike could talk up here for 45 minutes about, but can you just talk about that a little bit?
Yeah. So let me take a step back. Bitcoin is a proof of work network. You have to solve a very hard math problem in order to mine the block and get the Bitcoin rewards for mining that block. Ethereum and Solana are proof of stake networks, which means you have to put your capital, your tokens at risk in order to get the opportunity to mine a block and get the rewards, and you have to run, in all three cases, you have to run servers because these networks are peer-to-peer, right? Unlike Amazon Web Services, where Amazon is your counterparty when you're looking to use compute from AWS, if you're looking to use compute from Bitcoin, Ethereum, or Solana, you don't necessarily know who's going to be running the machine that serves you that transaction. But you give them a little money for that right, just like you would pay AWS at the end of the month your bill. You pay it, though, on the transaction in a fee to use Bitcoin, Ethereum, Solana, other blockchains. I think the question that I'm being asked is on Ethereum, maybe even on Bitcoin, you can run it like on a Raspberry Pi. Raspberry Pi is like a little, hardware device you can buy for $30. I don't know. Obviously, that would be incredibly inefficient for Bitcoin. You'd never solve the problem, so you'd be spending, some electricity, and you'd get, virtually no Bitcoin back. So, but theoretically, you could participate in the network. With Ethereum, if you have a bunch of stake, in other words, if you have a bunch of ETH, you can run a node, and they're fairly inexpensive to do so. On Solana, because it's a very high bandwidth network, the compute needs to participate in that network as a server are higher. Solana processes about 120 million transactions a day, okay? That's, Ethereum is 7 TPS, so it's about 7 transactions per second. Solana is about 4,000 transactions per second and has a theoretical capability of 65,000 transactions per second. And soon there's a new technology that we'll be implementing that will move that up to 1 million. So as the blockchain gets more utilization, we'll go hopefully from 4,000 TPS to many tens of thousands, hundreds of thousands, maybe even more. Whereas Ethereum is kind of hard capped at 7 TPS. So just the amount of bandwidth required is magnitude higher, many magnitudes higher than Ethereum. So it just costs more to participate in that network. However, there is a new technology being developed. It's an entirely new consensus mechanism for Solana. Solana's proof of stake consensus mechanism was called proof of history, which was a modified proof of stake consensus mechanism that the founder kind of had this big idea from radio networks where you could syndicate, multiple concurrent messages at the same time. Parallelized block production is one of the hallmarks of Solana. The new technology that's being implemented is called Alpenglow, and it will separate voting and non-voting transactions. And I'm getting into the weeds a little bit, but the key thing to know there is it will radically reduce the cost to participate in the network. So it will go from tens of thousands of dollars to participate in, as a validator in the network profitably to, single-digit thousands. So still, not, on a Raspberry Pi necessarily, but, considerably more widely available. But even today, with the network running as it does, there's over 5,000 independent validators participating as servers in the network on all 7 continents. So everyone, everywhere in the world is contributing to the decentralization of Solana, and we'll just see that further decentralized over time.
Before I go on, Mike, do you have any thoughts or comments on things that Manish and Nick just said?
Well, I mean, the biggest thing that I would highlight is that when we talk about transactions, I think ultimately transaction processing speed, I think Nick is spot on, and that what we really need to focus on is dramatically increasing the capacity of the system so that we can lower the cost, right? It's not that we're going to be sending more large block trades over the institutional space, it's that we need to get to the point that my purchasing of a coffee at the local coffee shop immediately and transparently executes so that we're able to settle that micro debt transaction between me saying I'd like a coffee and them saying we need you to pay it, right? Those things are incredibly important. A lot of the behaviors that we see, so like I disagree with Manish about Bitcoin, for example, are actually unfortunately byproducts of people who didn't understand what they were actually doing and trying to create something, right? Bitcoin, it's, Great Yawp was the white paper published in 2009 with the bank failures. Its objective is to try to get rid of banks, right? It actually succeeds at that. The structure of Bitcoin prevents the use of credit or debt on the system, but that actually then means that you can't have an elastic money supply that accommodates things like we were just discussing, right? An option or a price in the real world, if properly defined, can't be negative. If I'm going to expand the quantity of real world assets into financial assets by 100x, I have to have a short-term flexible source of currency that we call banking credit to facilitate that, And so Bitcoin cannot work. Right now, I can tell you that over and over and over again. What they've actually done is creating a massive deflationary currency with adherence that in turn caused the price of it to rise as people speculate in it. And they correctly point out the price of everything is falling in Bitcoin. That's right, because you built a fantastically deflationary asset, labeled it a currency, then you turned it into store of value, and now it's simply a speculative asset. We'll make it past those points, but it's really hard because we've now got a number of really enabled and wealthy individuals who basically tie that to some meaning of truth that the price is very high, right? We'll fumble our way through, we always do, but it's actually a barrier to success as compared to a path forward to success in the same way that the Genius Act could have been 1,000 times better.
Yeah, I'd say most people think of it now, they're not going to use Bitcoin as buying a coffee, but they view it as a digital store of value. But I guess, so my next question for you, Mike, is like what most people here want to know. Like, how do I bet on this happening or not happening? Like, do you just short or buy Solana or Ethereum? Obviously not investment advice, but like, if you were playing this space, aside from starting a company like Manish, like, how do you take advantage of these technologies or bet against them?
So my candid assessment is actually the answer is to do what Manish has done, right? If you actually really do want to participate in this, be innovative, start a company, follow through on your convictions. For the vast majority of people, though, they just want to know what to do with the dollar that they have left over that hasn't gone to their increased rent, insurance policies, milk prices, egg prices, et cetera. And that's where players like Manish or Simplify or others can come in, right? We're trying to create the product that ultimately becomes valuable to allow those individuals to save that dollar, to invest that dollar, to transact it and invest in things that they otherwise might not have had access to. And again, what excites me about tokenization is just that it opens up a canvas for creating new stuff, right? In the same way that having a very simple art set allows you to do certain things, when you expand into the digital realm, all of a sudden fantastical concepts like negative prices can actually exist. And suddenly I can actually do things that other people have never imagined possible. And so for me, that's the excitement.
Manish, how about you? What do you think? Obviously you built a company and your life is levered to this being successful, but like, how else do you think people should be able to, or would you think people could bet on or against the growth here?
So I would say this. We have gone through a phase where every company has become a software engineering company. So it doesn't really matter what industry you're in. You have a computer, you are on Bloomberg, you are coding Excel sheets, you're coding databases. Very soon, if you don't pivot, you are all going to not be here. So that means asset managers need to become tokenized fund managers. The broker-dealers need to become tokenized broker-dealers. You have to accept what's already here, which is the payment rails are here. Assets are getting on public blockchain. And I think it's no longer when it's going to happen. The question now really is how fast can it happen, right? So we've talked about where we were, we have heard a lot about where we're going. But I think we are here. I think these assets are here. These assets are going to continue to move forward and march forward on a public blockchain, and they are going to become more programmable. They're going to become more composable. And to Mike's point, you're going to see some fantastic products coming out, right? I mean, just yesterday we announced the $1 billion housing infrastructure, which is we're going to tokenize from the dirt up, not just the fund itself, but from the dirt up, the housing that is being built and will be tokenized and will be accessible on Solana. So I think my last word would be tokenized.
So how fast is it going to happen then? Before we go to Nick, we got real quick. You're saying it's going to happen faster, but how fast are we talking? So within a decade? Within 5 years?
So it seems like it always takes longer than you think. It happens faster than you thought, right? So I think in the next 5 years, you will see a majority of the players on chain and trading on chain.
Yeah, I mean, NASDAQ has filed recently to trade tokenized stock. I think everybody has been toying around, playing with this space, whether publicly or not, that I talked to for a very long time. We've only got 25 seconds left. I don't know if you have any final things you want to say, Nick.
No, I think my fellow panelists nailed it. I sat in as a fly on the wall recently, Grayscale, which is a crypto asset manager in the public company space. Came to Boston, where I'm based, and they had a luncheon to educate wealth managers about digital assets. And there's been this movement of get get folks off zero into Bitcoin, and then they're starting to educate investors about smart contract blockchains like Solana and Ethereum. But I think the real alpha is what both of these guys said, which is to use the blockchain. If you start there, using the blockchain, you'll go the other way. You're going to see the value yourself by using it, and then you're going to want to have as many of those assets as possible because you're going to see how far ahead you are than everyone else in the world.
All right, that about wraps it up. Thank you everybody for your time.